It's 11 o'clock. I think we'll get going because there's a bit to get through this morning. So as usual, I'm going to cover a bit of news, what's going on in the sector, and then Andrew Mahatch is going to be talking about what happened over the course of February. And then I'll be talking to the manager or one of the managers of Octopus Renewables Infrastructure. So let's get going without further ado. So three things I pulled out. I'm not going to dwell too much on any of them. It's Aquila, Princess Private Equity, and Chalkpoint Social Housing. Aquila Energy Efficiency first. First thing to say that it did fail its continuation vote. And it needed 50% to pass that. So there's a sort of a reasonably narrow margin there. But quite a lot of the shareholder register did vote. So I think that's a reasonably convincing argument that it does need to go. So what the directors say now is that under the terms of the continuation vote, they now have 6 months to decide what to do next, whether it's a reconstruction or a reorganisation or put it into liquidation. Obviously, if they do put it into liquidation, there's a kind of long run-off period. Our preferred solution, as we've said on various things, is to merge it with something else. But and most importantly, I think, is that the board is going to be guided with what the shareholders want to do in this. And so if you are a shareholder and you have a strong view, then please do communicate that with the board. The discount narrowed on the back of this, but it's still around 20%. So there's still a lot more to go for. But part of the problem that we've got is that there's been a general widening of discounts across the sector, as I'll show in a minute. And of the two other energy efficiency funds, the Triple Point one is actually now trading on a 31 discount, and I'm not sure that's entirely sustainable either. But the sort of flagship fund, the SDCL Energy, is on a discount of 13.6. That's not a complete barrier to a merger, but it does probably mean that people will need to be offered a cash exit opportunity as well. Now, very reasonably, one of our users did put a comment on the news story that we did here saying, why did we want to vote? Why did we feel that we should be voting against continuation? It was now fully invested. I mean, one of the problems with it was it took a long time to get invested, and once two of the directors walked out on the back of that, had sort of railed the managers. But it had actually got to a stage where it was committed all the IPO proceeds and hadn't invested all yet, but that sort of happens over time. And the stuff that they had was going to generate a portfolio yield of about 8%, so it's really not too bad, sufficient to cover the 5p dividend that they were planning for 2023, although it's substantially covered there because obviously not everything's going to be running for a full year, even now. And the manager said it had a big pipeline of deals, so room to keep investing stuff. And I think we've also said before that just because a fund is small doesn't necessarily mean that it needs to go. Big part of that depends on what the ongoing charges ratio is, and this case is 0.9%. So from that point of view, really not too bad. But this, as I say, is the discounts. So Aquila here in the pink, and you can see where it fell off a cliff when the directors walked out on the lack of progress. But the whole sector's been gradually derated over the past kind of, since 2020, this chart. And for the past few months, on average, well, this is median rather than average, it's trading at a discount. Really not great. And I think that shows you that there's an overall problem with the sector's got in terms of keeping shareholders' interest, and there could be any sorts of number of reasons for that, and I'm not going to try and work out what the problem is here, but it's just something to note. And I think that in itself tells you that if shareholders aren't that really enthused, and this is the smallest of the funds that's around, I just think, given the history, it was going to take an awful long time to recover. There's a question mark, I suppose, about whether there's too many renewable energy funds now. So 22 funds in the sector is quite a lot. And that's a lot of different voices shouting for attention. And to say this was the smallest of them. I also wonder if they upset shareholders by saying, well, if you vote for continuation this time, you're not going to get a chance to do so again until 2027. That was the other vote that they put to shareholders at the meeting the other day, was to change the articles to do that. I think maybe people were a bit unhappy about that. But there's also another problem that sort of came to light as I looked at it. It's actually a lot of the portfolio is in things that are really relatively short term. So a lot of this is sort of Italian super bonus stuff, they call it, where they basically get a kind of tax credit for funding energy efficiency projects. Some of these things are only sort of 18 months, a year long, and that is well over a third of the portfolio. And so you sort of question really whether they piled a lot of money into that just to show that it looks fully invested. But most of the renewable sector, you expect to have much longer contracts. And so I think on that sort of basis too, I'm just a bit unhappy about it. So my conclusion was, yeah, it definitely did need to go, but there we go. Princess, this is all about currency hedging. And it's got about half of its assets in North American investments, but it's a sort of European Euro type based fund. And so it's been hedging all of its dollar exposure back into euros, and it's been doing it for a while now. And obviously the dollar's done this, and that got progressively more expensive in terms of the margin payments that they're having to put down to keep this currency hedging going. We talked about it when this happened, but back in November last year, it had to suspend its dividend, and then it had to suspend all of its new investment activity, and that was really because it's running out of cash. It had a credit facility, which was 80 million euros, and they expanded it to 110 million euros, but by the end of September, they only had 9 million left of that left. They had unfunded commitments that they might have to meet of 100 million euros as well. And they had a portfolio of senior debt, which they've been selling down to free up cash as well. So basically, it's sort of running out of money. I mean, it's all a bit, just whether it's a real problem or not, but because it's all done with this voluntary currency hedging thing. Anyway, so what they've said at the end of February is that they're going to abandon this now. And by abandoning it, it just frees up everything. We can start paying dividends again back in June, so it pays out 5% of its NAV each year. The chairman, who's been on the board for 13 years, has said he's going to step down at the AGM. I think that was probably sort of a problem that shareholders will have with it as well. And they've also expanded that borrowing facility again, so that's now 140 million euros, so it gives them a lot more flexibility. So as we stand now, it's got plenty of room to meet whatever commitments it's got to new investments, and it probably could start making new investments again now. So that sort of sorted it out. Of course, what's happened probably is, because nobody can tell what's going to happen to these things, but you strongly suspect that the general trend is going to be going back down that way. It entirely depends on what happens relative with US and European interest rates. We'll wait and see. But yeah, the worry would be having hedged it the wrong way all the way up, then it now becomes a useful thing when they're not doing it anymore. But there we go. Triple point social housing, last thing from me, just a very brief mention. Normally we'd hand over to Rich at this point, but I agree with him that I'd cover it off. Massive widening in the discount from about here. We know the reasons for that. There's been this back and forth with the regulator. There's sort of been these problems with individual registered providers that are renting their properties off them. A couple of those have not been paying rent. I'll talk about in a minute. So the discounts reach something daft, really. Well, not daftish, 50%. In the results that have just come out, it collected 91.8% of rent that was due. That's not great. It is trying to sort out the underlying problems with the individual things. So one of them is Myspace, which we know is probably a goner. Everybody seems to be reassigning the leases from in Myspace's name to other registered providers. There might be some NAV loss around that, but it's going to be minimal, because the rents will, start to flow again, and the actual value of the property shouldn't be that much dented. One of the beauties of this thing is that it has got inflation-linked income. So most of it is linked to RPI or CPI, It's voluntarily capping the increase this year at 7%, which is obviously going to get it in the government's good books. And there's no real reason why not, that this thing shouldn't be recover. But the big thing that I wanted to flag is that finally the board is saying, well, things are trading on a 50% discount. What we're going to do is maybe look at selling some of those properties and using the cash to buy back shares. So by selling the properties, we should demonstrate that the NAV is real. And if we buy back the shares on a 50% discount, that's massively accretive to the under NAV for ongoing shareholders. So that could be the trigger that gets this discount to narrow. Of course, we have to wait and see whether they can achieve this or not, but I just think that's worth flagging. Now, a couple of questions I'll just address before we hand over. So there is a question about whether funds should pay dividends from capital. The question is saying, do you think the private equity should pay dividends at all? Yes, it is a repayment of capital. Some people like it. There did seem to be a pickup of interest in some of these trusts when funds started doing it. I don't think that's enough to turn the tide if there's anything else wrong with the fund. But it's an extra little tick in the box that some people like. I'm not a massive fan of it. I think the big question this year is what's going to happen if NAVs have gone down and the dividends are going down. Will people get a bit upset about that? There's another question here about the home REIT, and RM is the sort of indicated that it might be interested in taking a management contract. I think at the moment we're sort of keeping stum on home REIT. It seems to be a complete legal minefield. So we're probably not willing to say too much, but I think obviously the fact that people are interested in taking the portfolio is good news. And if some solution was found that would keep the homeless tenants in properties and those properties could be upgraded so they're actually fit for habitation, that would be fantastic. But obviously when anybody does their due diligence on it, whatever skeletons come out of the cupboard, you just don't know what it's going to be. So I just question kind of watch this space, I think. Right. On that note, I'm going to hand over to Andrew. Good morning.
That's great. Thank you very much indeed, James, and good morning, everybody. Let me just switch over to my screen. You'll be relieved to know, James, that I'm not going to devote my entire segment to home REIT, or any of it, in fact. So we'll have a look at the movers over the month as usual. It wasn't a particularly good month for investment trusts, which were down about 1.4%, I think, on average. But as always, quite a lot of variation within that. So some reasonable gains, nothing too exciting here, I don't think. The theme that I picked up on is that of corporate activity, really, and the fact that perhaps the absence of IPOs from the market means that the corporate finance departments have a bit of time on their hands, and they are working with boards now to do a bit of spring cleaning a little bit early this year. So I've highlighted two of the movers here. James just mentioned the Aquila Energy Efficiency failed its continuation vote, and Aberdeen Smaller Companies Income earlier in the month also announced a strategic review, which I think may end up with a merger, but we'll wait and see. I'm just going to see if there are any other trusts that share some common characteristics. And then amongst the fallers, well, I mean, here we have the four China trusts, which seem to appear on either the fallers or the risers every single month. There's clearly ongoing volatility in that sector. And the other highlight for me here was the fall in a couple of the renewable energy trusts. Again, it's nice that James and I are singing from the same song sheet here. I also picked up on the derating of the sector So I'll talk about that after we've looked at the spring cleaning aspect of the market. So the thing I noticed really about several trusts now that have indicated they're undergoing strategic reviews or thinking about their futures in more concrete ways. They tend to have some common characteristics. They're generally smaller trusts trading on wide discounts. And there's perhaps some kind of trigger as well for the corporate action, which may be a specific date that is already predetermined for a continuation vote or a potential repayment of capital or tender offer, something like that. So I just had a look around to see which trusts might have similar criteria, might meet some of those. This is not a list of potential takeovers or winding ups because I have absolutely no knowledge of that. But I think it's interesting to look at these opportunities because they do have some of the same characteristics. So here's the list. It's in order of size here, starting with Premier Miton Global Renewables. It's in a good, interesting sector that's generally well supported, which I think makes it a bit more surprising that it's on a wide discount here of 18%. It has a continuation vote every 5 years. The next one in 2025. It is a small trust and it's geared with ZDPs, which expire in 2025 as well. So that is a pinch point for the trust on just to see whether it can refinance the ZDPs and whether it's going to continue. If it can't do that, it's probably too small. And I think here the investment proposition is interesting because you have that scope for the narrowing discount, which is much, much wider than the only other competitor trust that really is doing a similar thing is the Ecofin one, which is that's Global Utilities, which is trading very close to NAV. So the investment proposition here is that you've got this scope for a narrowing discount and actually you're in a decent sector as well. So you can sit tight and take a reasonable yield as well. Downing Strategic Micro Cap, again, very small, hasn't performed well on a persistent discount. There's a redemption opportunity coming up in 2024. If enough people vote for that, I think that trust may struggle to continue. Jupiter Green, I always feel really sorry for Jupiter Green because it was just too early to the party. This was the forerunner to the whole environmental movement, but way too early. And as a result, sadly, it didn't have a good track record to begin with, and it's always struggled to achieve scale. Still too small. Continuation vote coming up later this year. Bearing Emerging EMEA Opportunities hasn't been a great place to be of late, of course, but just same sort of things, quite a small trust, trading on a discount, tender offer may be offered in 2025. That depends on performance and discount, so we'll see if that comes to pass. Baker Steel Resources has done poorly of late. I think it really needs a win in its portfolio, otherwise shareholders may run out of patience. It's on a very big discount, although it's largely unquoted assets, so the value of those is not completely certain. Continuation vote coming up in 2024. And the last one on the list is Menharden Resource Efficiency. Again, just over 100 million, very wide discount. Continuation vote coming up in a couple of years. So those are all interesting trusts. There's nothing on the horizon there. I'm not aware of any news, but if there is a period of consolidation in the market, then you would have to say those trusts could be on the list. So now I'll just move on to this, derating that we've seen in the renewables infrastructure sector. And this trust really seemed to stand out. And I feel it may have been overlooked somewhat because I think it's not on everybody's radar. And I did notice that it's not on in the data that I get on a daily basis from JP Morgan. So perhaps not everyone's aware of this considerable derating that it's undergone. This was launched in July 21 when there was a lot of excitement around hydrogen, and there was the climate summit in Glasgow at the time, which meant it went to quite a large premium when it launched. And it hasn't really done anything wrong since that time. It's invested the money, its NAV hasn't really changed. But of course, there's been this big derating. And I think the trust probably needs to prove its value. Most of its holdings, 7 out of 9, are profitable, or generating cash anyway. Sorry, revenue generating rather than necessarily profitable. But I think it just needs to probably have a bit more proof, a bit more transparency. It's trying to do that. It's just had its first capital markets day. But nevertheless, on a 32% discount, I mean, you'd have to say there probably is a bit of value there if you're prepared to look at the trust. So that's an interesting one. And it does reflect, I think, what's happened a bit more broadly across the sector. That, as James mentioned, the ratings in the sector have certainly come down. In part, I think there's been a few news stories coming out about the increase in cost of wind turbines and the difficulty of getting all of this new energy actually plugged into the grid, which is a major issue in the UK. That tends to be actually what developers talk about. Is really the access to the grid that's the big lag in terms of getting these projects completed. The New York Times said this was a problem in the US as well. So a bit of negative publicity, but honestly, I think that's probably outweighed by the mass of goodwill towards this sector, which does make it a bit more surprising that we've seen these sharp deratings. So on this chart, the blue line is the current discount on these 7 trusts that I've listed here. And the red line is the average rating over the last 12 months. So you can see they've all derated actually quite substantially. I think Hydrogen 1 is the biggest derating of the lot. But you also have Gore Street Energy Storage, which has moved from a premium to a discount. Same for SDCL Energy Efficiency. Octopus, which obviously David will tell us about, has also derated. So it's certainly a sector-wide shift, but I think it does create some opportunities. And just to finish, I'll talk about SDCL because there was a note from Stifel this week upgrading the shares really on a valuation basis to positive, and noting that whilst the share price was at historical lows, this didn't really reflect what was happening in the portfolio. Interestingly here, the broker felt there'd been a lack of transparency. And I think, that's an interesting point, that perhaps these renewable energy trusts, which have had so much support and so much goodwill and so much backing, maybe they need to work a little bit harder with their messaging now to make sure that they are fully informing the market of exactly how they're achieving their returns and where the risks are. In this case, the trust is having a capital markets day in 11 days' time, so that may help. And I think, you can very clearly see the derating on the chart, which is very substantial. And I think the other point to make here is that if you are interested in the sector and thinking that perhaps this derating gives you an opportunity to buy in, of course, a major factor is that as long as you can be reasonably patient and wait for the valuations to change again, you can get a very good yield in the meantime. On this one, it's 6.7, which is a very attractive yield just to sit and take while you wait for things to change. And I think in general, because these trusts are quite ambitious in terms of wanting to expand further and raise more capital, I'm sure they will be wanting to get their premium ratings back and will work as hard as they possibly can to do that. So I think there's some interesting opportunities there, which is a nice lead in to your conversation with David, James.
Thank you very much.